So, let me ask you this. What do you think is the biggest mistake investors make? I mean, is it picking a dud stock, buying at the very top of the market? Sure, those things hurt, no doubt. But the real number one mistake, well, it comes from not even asking the right question in the first place.
And this slide just nails the difference, doesn't it? The average person, the crowd, they're completely fixated on one thing. What should I buy? It's all about the get in. But the pros, the disciplined investors, they start thinking about the end game from day one. They're asking, okay, when and why am I going to sell this? They have their exit strategy locked in before they even think about hitting that buy button. And believe me, that one little shift in perspective, it changes everything.
Okay, so if we're going to build that kind of rock-solid plan, we have to start with the biggest enemy we'll ever face. And it's not the market. It's us. It's our own emotions. You got to get this. Before you can even think about managing your portfolio, you absolutely have to learn how to manage your own mind.
And this quote, man, it just cuts right to the chase. Think about it. When the market's on fire, that little voice of greed starts whispering, chase it, get in on that, don't miss out. And when everything's crashing, that voice turns into a primal scream of fear. Sell everything now, get out. Both of those impulses, greed and fear, they push you to do the exact opposite of what actually works. They make you buy high and sell low.
So how do you fight that emotional roller coaster? Well, the answer is to become a contrarian. Now, hold on. This doesn't just mean being a rebel and doing the opposite of the crowd just because. No. It means you've done your homework. You have a solid belief in an investment, and you have the guts, the conviction to buy it when everyone else is panicking and selling it off cheap, and, just as importantly, to sell it when the whole world is jumping on the bandwagon and getting greedy.
I really love this quote because look at that word emotionally. We all know intellectually that the market is uncertain, right? We can nod our heads and say, yep, it's risky. But feeling it, truly accepting it in your gut that things are going to get wild and not letting that fear take the wheel, that's a whole different ballgame. And honestly, getting to that place emotionally, that's the bedrock. You can't build a solid strategy without it.
Okay, so we've got the right mindset. We're ready to embrace the chaos. Now what? Let's get down to brass tacks. How do we actually build this thing? How do we architect an exit plan that's going to save us from ourselves when the market storm hits? Let's do it.
You know, Yvonne Banerjee has this great term for a common trap, the lottery mindset. You know what this is. It's when you buy a stock and your entire strategy is just hope. You're just hoping it goes to the moon, right? You're clutching a lottery ticket. But what's the plan if it doesn't? There isn't one. And that way of thinking leads you straight into chasing whatever's hot and, you guessed it, panic selling the second things get a little bumpy.
So, to beat that lottery mindset, you need a toolkit, a real one. These are your rules of engagement. For instance, a price target. This isn't just a number you pull out of thin air. It's based on your research of what you think the company is actually worth. Then you have loss limits. You might know them as stop losses. This is you deciding ahead of time, this is how much I'm willing to lose before I cut my losses, period. It's your financial pain threshold. Time frames are great too. It's like setting a calendar reminder. In 1 year or 2 years, I'm going to sit down and seriously reevaluate if my original reasons for buying still hold up. And finally, triggering events. These are deal breakers. A new CEO comes in and changes everything. A huge competitor emerges. Basically, something fundamental changes that makes your original investment case totally invalid. These are your non-negotiables.
And this, right here, this is the golden rule of this entire explainer. You have to decide on all of this stuff, your price targets, your loss limits, all of it, before you put a single dollar into the investment. You do it when you're calm, cool, and collected. Why? Simple. You are not the same person in the middle of a market meltdown. The you that's panicking is not a rational decision maker. You can't trust that version of yourself. So you make the rules for them ahead of time. And of course, we can't talk about a robust strategy without mentioning diversification. It's the classic, don't put all your eggs in one basket, right? As planner David Tinarelli says, when you're spread out, a bad day for one single stock is just noise. It doesn't throw your whole plan off the rails. It lets you stay disciplined and focused on the big picture. All right, so just because you have a personal plan, it doesn't mean you stick your head in the sand and ignore the market. Not at all. But here's the key. We look at what the market is doing, not to predict it, because that's a fool's game, but to prepare ourselves. It's about recognizing the patterns so we're not shocked when they happen. Let's take a bear market. When you're in one, it feels like pure chaos, but they actually tend to follow a pretty recognizable script. First, there's denial. Nah, it's just a little dip. Then comes the panic. This is the big one. This is when the media is screaming recession and everyone who doesn't have a plan sells out at the bottom. After the panic, things kind of stabilize. The bleeding stops, but everyone is still miserable. And then, quietly, when no one's really paying attention and the mood is still awful, the recovery starts. If you know this cycle, you see the panic phase for what it is, a painful but totally normal part of the journey, not the end of the world.
So knowing the cycle is one thing, but trying to predict the exact top or bottom, that's a fool's errand, seriously. And Larry Swedroe just puts it perfectly. Ignore the market forecasts, all of them. The gurus on TV, the newsletters, it's all just noise designed to distract you from the only thing that actually matters, the only thing you can control, your plan.
But just how bad is that noise? How good are these gurus, really? I want you to just look at this number for a second. 46.8%. Just let that sit there. What do you think that represents? That is the average accuracy of market gurus, based on a massive study. 46.8%. That is worse than a coin flip. Let that sink in. You would literally be better off making your investment decisions by flipping a coin than by listening to these so-called experts. And that is why having your own disciplined, well-researched plan is 1,000 times more valuable than any prediction you'll ever hear on TV.
Okay, so let's tie this all together. What is the disciplined investor's edge? It's not some secret stock tip. It's a combination of three things: that contrarian, unemotional mindset, a rock-solid exit strategy that you built beforehand, and a clear understanding of market cycles, used for preparation, not prediction. At the end of the day, it really comes down to this simple, classic idea. Stop trying to time the market. We just saw the stats. It's a loser's game. The real path to success, the proven one, is time in the market. That means sticking with your plan through the good times and the bad and letting that strategy do its work over the long haul.
And this really is the key takeaway I want you to leave with. Success in investing isn't about being a genius who's right all the time. It's not about perfect results every month. It's about one thing: trusting the process, trusting the rules you created when you were thinking clearly. It's the difference between reacting emotionally to the daily noise and acting strategically based on your own plan.
So I'll just leave you with this one question. Take a hard look at your own investments, your own plan. Do you have an exit strategy for everything you own? A real one, written down? Is your plan built to survive a crazy market? And maybe even more important, is it built to survive you?